3, 2, 1. Welcome to the show.
All right. Getting close to the end of January.
Man, I feel like it was Thanksgiving yesterday.
Seriously.
I know. You always hear like old people talk like that. You know.
Yeah.
I don't know if I did when I was in my 20s and 30s, but now I just look at a week and I go, "What the heck happened?"
It goes by quick.
I was like, unwrapping Christmas presents, last weekend or something, and now all of a sudden it's into January, and I'm already mapping out the year for the different travel things that we got going on. Jerry and I are trying to take advantage of being semi-retired.
Yeah, it's got
a little sailing trip where we're going to do some courses, take some sailing courses and some taking a motorcycle trip.
Yep.
And so hopefully that won't impede on our ability to talk to you guys.
No, I'm sure not.
We'll figure out a way to still do the show.
That. Yeah.
So what you got for us this week, man?
Yeah, it's interesting from a normal person's perspective, like you just said, the how time goes by. We're it's the 22nd of January, right, when this podcast comes out. So we're almost done with the month, and everybody's still talking about 2022.
Right. Because it was horrible.
It was horrible, right? But the idea is that the market tanks in the first half of 23, and then recovers in the second half. That's the certainly what all the analysts expect, and we haven't really seen it yet. And so, the more time that goes by, and it's questionable whether or not we were in a recession before, and if we're going to have one later in the year, or maybe it all gets pushed into 24. It's hard to make long-term decisions when.
Yeah, there's just too many variables going on right now, and too many opinions, too many assessments. Why? Because nobody knows.
Right, nobody knows.
You don't know.
And any one little input has an effect, but it takes big things over time to drive the market forward. And so fourth quarter last year, people have all these expectations for first quarter next year, and we're still basically in the same position as we are right now.
Here waiting.
Yeah. So it's hard. It's grinding.
Yeah, I heard somebody say it, and I wish I'd written down the quote because I won't get it right, so I won't try to repeat it. But it was basically a really simple version of, X has to happen for this to happen. If this has to happen for this to happen, which will make all of this, move in the direction that it needs to move, and none of those things are happening. So we're just sitting here,
right?
And that is what we're doing. And so, and none of those things, these are all, macroeconomic things that don't move overnight,
right?
That aren't going to change in January, maybe Q1, right? Maybe the first half of the year. It's definitely not going to happen the first week of January.
No.
And so you got all these people that are just clamoring and going crazy, and it's like nothing's changed. It's just been a month.
Yeah.
Just because the ball dropped doesn't mean the whole world changes.
That's right, and that's the whole idea of you test your results. What was your 1 month rate of return, 3 months, 1 year. Like the dates really don't matter. You have to consistently. I think a year is the lowest real performance point. Yeah.
It's nice to see. I mean, we have that, right? The year, not year to date. The 1 month, 3 month,
all that.
Yeah, year to date and 1 year is the lowest performance metric you should even be thinking about if you're a normal investor, which I think all of us are.
Yeah.
You're right. We're not. It's a whole different. It's hard to be that way though, right? It's hard, and I equate it back to when we used to have the gym. We had a gym for 5 or 6 years, and I need to get back in it. But but the gym, you get people just like, I want to lose 30 pounds, and I'm like, well, how long did it take you to get it?
Yeah,
you're like 5 years. I'm like, well, you don't get rid of that in 12 weeks.
Right.
Even though the commercials tell you that,
right.
You can't get rid of that in 12 weeks. It takes 12 months if you do everything right, and it might take 3 years because it took you that long to get it.
Right.
And so, investing's no different.
Yeah.
I think it's consistency. It's time.
It reminds me of like running a marathon. Literally running a marathon.
Yeah.
And you go by. You get to like 17, 18 miles, and you go by the little flag that says mile 17, mile 18, and you think about, okay, great, I only got 6 more flags to get past, right? And so that's kind of the long-term perspective of it. And then you're like, how you feel as you're passing that 17 flag is, how am I going to get the next 10 steps?
That's why you only worry about one flag at a time.
One flag at a time. Yeah. Yeah.
All right, man.
All right. So actually, this kind of goes to what we're going to talk about a little bit. So, what do I do now? We're going to talk about some ideas about what you can do now, and it's really perspective. It's not what should I do now, what fund should I invest in. It's how do I come to this? Coming off of a really, really bad year, what do I do now? How do I kind of come to it?
So it's 20. The last year sucked. What do I do now?
Yeah, pretty much.
yeah. Okay.
And then iFund making a comeback. I put out a chart earlier this week, and I'm going to kind of do an update to that chart a little bit. But the two funds that people love to hate is the iFund and the F fund, and we're going to kind of do a little bit of a deep dive into both of them. The bonus chart is a 10-year yield, and I have F fund in parentheses there. F fund doesn't. The 10-year yield isn't exact to the F fund, but we're going to talk about it. It's a pretty good guide. And then the TSP fund charts. All right. So what do I do now? Basically, you have either ridden out this bear market so far. So you've been in the stock funds in 2022. You're down 20+%. And made some of it back in the last quarter or in December. So maybe down 20%. Or you got spooked out or otherwise had a bad gut feeling at the end of 2021, and you went to the G fund and you've been in the G fund throughout 2022. And so if that's where you are, great. You didn't take any losses. You got a little bit of gains. And you've seen the market come back a little bit. Now you're wondering, well, what do I do now? And if you follow along with our alerts, you're about flat for the year. Now we're a little bit up. We were up a little bit this year so far. But what do you do? Right? You're following the plan, so you pretty much already know what you're doing. But either any of those three categories, your personal come from is going to be either greed or fear, right? I need to grow my TSP account, right? You're getting close to retirement. You just took a 20% hit this year, and you really need to get that 20% back. If that's your come from, that's one place to be. You're retired. You took a 20% hit, and you can't afford to take on any more losses, right? So now you're coming from a fear perspective. So the thing about what do I do now, it isn't for somebody to tell you what to do. We're certainly not going to tell you should you be in the C fund because C fund's down 20%, and the odds are that it goes up next year because it went down last year. That's just not how we play the game. For all of us as an individual, you got to get your mind around what has already happened, and wherever you are, you can't get it back, and so you have to start from today. Whatever you have in your account is what you have, and you can either hope that the market comes back, and there can be all kinds of reasons why you think that's going to happen, and that's great. Or you can be afraid that the market's going to tank worse, and there's plenty of reasons to think that's going to happen. But until something actually happens to move the market in one way or another, the best thing you can do is get educated and see where the lines are that increase the odds of it moving in one direction or the other, and then make your reallocation based on which way the market's going, not based on which way you hope it goes or are afraid that it's going to go.
Yeah, and that all comes down to what we generally say is you have to have a plan.
Yep.
Like if you have a plan already, then you need to spot check it, right, and say, is it working?
Yeah.
Tweak it, right? Make it better. Make it, hopefully make it better. So good on you. You have a plan, right? So now's the time to tweak it. If you don't have a plan, you've got to get one, and it can be a simple plan. It doesn't need to be a complex plan. And if you follow us enough and read our ebook and do all the resources that we've already got, now you don't have to wait for it. You can make a plan. You can figure out how to make a plan. And then I guess the third option is just hope.
Yeah, hope for the best. So I just want to, when you say make a plan, when we say make a plan, it's based around the market. It's not based around you and your goals and your dreams and what you need or what you're afraid of.
The plan is, what do I do if the market does X?
Yes.
What do I do if the market does Y?
Right.
And I've got an option A and I've got an option B. And it's not that hard, right? And it's a weekly decision. It's almost like sitting down weekly and balancing your checkbook like we did back in the day, right? Old school way, you pull out your physical checkbook and you put all the stuff in it. You wrote the checks and you balance it out. And nobody does that anymore because computers do it for us. But this is generally the same thing. You know, once a week you sit down and go, okay, what's going on with the market? If X happens, I'm going to do, here's my option A and B.
Right.
If Y happens, here's my option A and B. You know, that's really how we attack it.
Right. That's the plan. It's not like I need to make up for last year, and so therefore I'm gonna invest more or less or whatever. Because
I'm all in on the C because that's the only place I can get 20% this year.
Or you can lose another 20% this year. That's
hope.
that unfortunately that is the plan that most financial planners do. Right. That's the problem.
Not even normal people, financial planners.
Yeah.
Yeah, because they're not really actively managing anything anyway.
No. All right. So with respect to what do I do now, let's just go through some of the long-term charts and kind of think about it a little bit, right? Here's the C fund weekly. So each one of these ticks is 1 week of price movement. And it goes, I did 3 years so we could see where we are at the low here from COVID. So, December... or the last, let's see, this is December right here, and into the beginning of the year, it was up, for 2 weeks, and there was a lot of optimism in December, and it came up and hit that downtrend line for 1, 2, 3, the fourth time, and then this week, if the market closes, so we're doing this on Friday, we don't have Friday's closing price in there. So it's this red candle is as of the close on Thursday. And for, if the market closes flat on Friday, we have an engulfing negative candle. So the odds of the market just turning back around here and breaking through this long-term downtrend line after putting in a negative engulfing candle are slim. Okay, it's possible. It's just not likely. The only thing on our side right now is that this low is higher than this low. Okay, but that's the only positive. You got consistent lower highs. Okay, so it's if you hope that the market's gonna move higher from here, you would be in the stock funds. If you're afraid that the market's going to move lower, you'd be in the G fund. If you have a plan that's based on what the market is actually doing, you look at it and you say, okay, we've hit resistance for the fourth time at that trend line. You have to respect the trend line. In my opinion, I need to see the stock fund, the C fund anyway, get above that downtrend line before it has a chance of moving higher. So until that happens, I'm not even considering the C fund. S fund chart looks different because you draw different lines and it's kind of different. But the most unfortunate thing for the S fund is this right here. If you could have drawn that line, if we didn't have this, that's the problem in the chart for the S fund. If we had a line from here to here, and the middle of it didn't go below it, then we would have this this triangle pattern that could possibly move to the upside from there. It's still a bearish triangle, but basically what I'm saying is I'm looking at it as optimistically as I can, and I'm not seeing anything good in the S fund either. I fund is much better. It's why we've been in the I fund for a while, and we've been talking about it for a while. If you connect the downtrend line there, you get this huge move to the upside. And so that was the time to get back into the I fund. Not that you shouldn't do it now, but clearly the trend in the I fund is much different. The chart is much different looking than the C or the S fund. You got a low here and a higher high here. So hopefully you guys can see that the trend in the I fund is much different than the trend in the C or the S fund. And then the F fund, same kind of way, right? You got a low here, a little bit of break above, so you have a higher high there. There are still some resistance points that are upcoming. we're going to talk about the F fund here going forward, but if we can get above this level in the F fund, it's very possible that we come up to resistance up here at 114. And so we're looking at projections to the upside for the I and the F funds, while at the same time we're looking at projections to the downside from the, Interesting, we get some technical difficulties. Don't know if you guys can hear it, but we're going to keep on going. So at the same time, we're looking at extensions to the upside in the I and F funds, but extensions to the downside in the C and the S funds. Okay. So I fund, for example, is the I fund making a comeback? Here's a long-term chart of the I fund, right? This is where the index started back here in 2001. If you guys remember, we talk about it quite a bit on the show. What this chart is EFA is the I fund divided by SPY, which is the C fund. Okay, so what that means is the I fund is the numerator, okay, and the C fund is the denominator. So if the I fund increases relative to the C fund, the line is moving up, which means the I fund is outperforming the C fund. Okay, and the reverse is true. When the I fund is underperforming, right? When the I fund is underperforming the C fund, the line goes down. So you want to be in the stock funds ideally you got 3 stock funds, right? You want to be in the one ideally that's outperforming the other 2. So the I fund relative to the C fund back here from 2002 to 2008, the I fund massively outperformed the C fund. Okay? And then from 2008 to 2022, or somewhere in 2022, the C fund massively outperformed the I fund. So now if you're looking at it and you say, okay, what does this big uptick mean right here? In the past couple of months, the I fund has been hugely outperforming the C fund, right? You can see that on the last chart. I fund was, the I fund chart is in a big uptrend compared to the C fund is in a downtrend, right? So it's consistent with this chart right here, okay? So the I fund is way outperforming the C fund right now. We've had that at other times, right? And it hasn't held. At some point, the trend is gonna reverse. This isn't a reversal of the trend. Let's say the I fund keeps coming up relative to the C, comes back down, and then starts moving higher. Now we have a higher low and a higher high, and now we have an uptrend in the I fund relative to the C fund. That's when it'll be really, really confirmed, right? And this is a long-term, it's a long-term chart, so you wouldn't really trade on it. But the idea is to see this and know, okay, there are still some possibilities that it'll fail, but if it doesn't fail, and this is really the bottom of the C relative to the I, then you want to give kind of deference to being in the I fund relative to the C fund over time. That's like for me, that's like my come from now when I'm looking at the stock funds. Okay. I don't know if I want to say anything else about that. That should give you guys an idea of you should really be looking at the I fund now, because most people are like, I fund, it's always CNS all day. All I'm saying is it might be time to consider that the I fund might start to outperform in the long run, and it's consistent with the macroeconomic. You wouldn't
say CNS all day if you were in 2002 through 2007, right? And I think most of the people, well, oddly enough, I have heard that from some people who were around back then, meaning they had the TSP, and it boggles my mind. Either you weren't paying attention, you don't know any different, you don't know any better. And that's what I hope it is. I mean, I hope you just don't know any better, meaning you're just not educated enough. Because if you are educated enough and you know that, then why would you be saying that? That you would never hear one of us say, I never go to pick a fund, any fund, because we look at it as 5 options. Right. Which one is going to perform better? Right. And people are still mind-boggled that we would sit in the G fund that long. How could you do that? You're losing so much money. And we're like, really? How are we losing money? Right. Have you seen our 3-year chart? Right. We beat the C fund because the C fund was going down, right, and we were getting 3%. Right. or whatever, 4%,
I mean,
give or take, right? The point is, you have 5 options. Why wouldn't you use them? I don't. Yeah.
Right. I mean, people get emotionally attached to particularly the F fund, which I think is odd, but the
Really
I fund
weird.
too. Yeah.
Because people don't understand bonds most of the time.
Yeah.
It's a bond, and if you ask 10 people to explain bonds, you're going to get 10 different answers.
Yeah. Well, strangely, we're going to get an answer about that kind of right now, actually. So, try not to have your eyes glaze over because this is a pretty good one. Much like the I fund, in a long-term perspective, could be reversing. The F fund is in the same way. Okay. So this is a chart of the 10-year yield. Okay. So when yield goes down, the price goes up. Okay. So since the high here in 1980, okay, this is a 40-year chart. So we had a high in interest rates here. The 10-year yield up here at 16% in 1980. That was the low for the F fund. Okay. So as yields come down, the price of the F fund goes up. Okay. So the reason that we have had that the 60-40 portfolio didn't work and all that last year is because when yield goes up, the price of the F fund goes down. Okay. So we had this huge move to the upside in yield, which means we had a huge move to the downside in price in the F fund. Okay. But now, after this 40-year decline, we put in a serious low here in 2020, and then yield started rising. Okay. So just like the chart, the long-term chart from the I fund, is this going to be some kind of big increase in yield over time? We don't know yet, right? We're going to know it when we get a pullback. If that pullback doesn't take out these lows and we start moving higher and it does take out that high, then yeah, we have a trend to the upside in yield. Okay. And if we get that, if the yield over time keeps moving up, the F fund goes down. Okay. So forget about all the macroeconomic things. Just look at it from the chart perspective. We got a 40-year decline in yield, and we have this pretty significant uptick here in the past year or so. And we're clearly outside of the downtrend line. So we could come back, tag that downtrend line, and keep moving higher. We'll have to see how it plays out, but the potential is certainly there. So if we zoom in from there are a couple possible counts. So let me go back to this real quick. Hopefully you guys can see. You got a 1, 2, 3, right? We came up off the bottom in 2020, corrected a little bit, and then have been moving higher ever since, right? From a long-term perspective. Okay. So if we bring it down to a shorter-term perspective, here's the here's the low in 2020, right? There are 2 possible Elliott wave counts going forward. You got 1, 2, 3, 4, 5 for 3, and then we're in this ABC for a 4, and then we keep moving higher for a 5. That's the first possibility, right? If that happens, so remember, when the yield is going up, the price of the F fund is going down. So when yield is going down, the price of the F fund is going up, okay? So if yield comes down A, B, C to give us a 4, the F fund goes up as yield comes down. So here we are right now. We've broken this support level, just barely, but broken it. So if we get an actual ABC where this A equals C, then we should come down to about 3% on yield, and the F fund should continue higher until we get there, right? Because the F fund goes up as yield comes down. So that, in the short term, is making me look at it and say, okay, the F fund should continue to go higher until yield gets down to about 3%, which is consistent with where we are because we are invested in the F fund right now. Once we get there, it should be a high for the F fund, because as yield goes back up, the F fund comes down. So it's not like we're going to be in the F fund for a very long time, just until we get to somewhere around 3%. Okay, that's one possibility. Here's the other possibility. Same kind of chart, but 1, 2, 3, 4, 5, right? And then now this is a 1 instead of a 3. And if that's the case, it's the same chart. It's just applying two different potential Elliott wave patterns. I don't like this one as much as the first one, basically because the distance between the 1 and the 2 on this chart is pretty long. And the distance between 3 and 4 on this chart is nowhere near as long as the 1 to 2. So I don't like that count. It's a legitimate Elliott wave count, but I think this one implies that 4 is down here, which gives us a lot more time in the 4. It's much more similar to the time that it took to get to the 2. So I like this count better. But they're both valid, so I'm looking at both of them. Either way, in the first one, we get down to, say, 3%. So the F fund continues higher for the next couple of months. In the next one, we get down to a 4 down here, right? And it would be a 2 instead of a 4. So if 1 is complete, now we're looking for some kind of move down to this prior 4, which puts, an ABC for a 2 down here at like 2.5%, which basically means the F fund goes higher for longer. Okay, so whichever of those counts play out, the F fund should continue higher for some amount of time. Okay, and it's same as the TLT and the Z-RAWs, all those things that are consistent with going higher as yields come down is what we're talking about. So whether you're talking about the mutual fund window or the AGG, the F fund, as rates continue lower, as the 10-year yield continues lower, the F fund should continue higher, will continue higher. All right, so that's basically the idea of why we are invested at this point in the I and the F funds versus the C and the S funds. So we've had a lot of questions on Facebook recently about, is it time to get back into the S fund? I think hopefully you guys got the idea of how we're kind of looking at it. The trend on the I and the F funds are both up. The trend in the C and the S funds are both down. I think it's pretty clear where you should be aligned based on what the market's doing, not based on what you hope happens.
Yeah, or what you think might happen, right? And I think it always goes to whenever we hear someone, kind of making an argument that it's on an uptrend, they're usually looking at daily, maybe weekly.
Yeah,
and that's not what we're talking about. Weekly would be the lowest,
absolutely lowest,
absolutely lowest, and even then, it's going to have to be like monthly.
Yeah. It's hard, and it's hard for me, and it's hard for people watching, because when the market goes up one day and we're not in it, especially if it goes up 2 days in a row and we're not in it, it's like I'm missing out on all these gains.
Yeah, we get FOMO too.
Yeah, well, sure.
We get fear of missing out, but you have to be disciplined enough and take the emotion out and say to yourself, okay, if you need reinforcement, just pull up one of these charts.
Yeah.
If you need to know to reinforce the fact that you're making a good decision, pull up the long-term chart and go, okay, all right, no, I'm good. I got to wait this out. Yeah, and again, this is only because we only have 2 moves a month.
Right.
If we had multiple moves, even if we had 4 or 5, life would be dandy.
Yes.
Right? We would just be like up one day and out the next and all, but that's not the reality.
Right.
So it's not that we're arguing that we shouldn't be in. We're not making that argument. In fact, many people, you might already be in. That's great. Because we don't know, and until the long-term trend has changed, we're not going to waste our moves, right? Putting ourselves in a position where we might not be able to get out,
right,
or back in.
Yeah,
that's really the key,
right? So we always only talk about the first part of the decision-making process, right? Mm-hmm. I mean, once you figure out that, okay, the trend has changed, and I want to get, let's say the market's going down, the trend changed and I want to get back into the C fund. That's the first part. Now you're looking at it going, okay, what if I'm wrong?
When do I get out?
When do I get out? Right. That's probably the second part. And then the third part is, okay, it's the 2nd of January. If I make this move, and the market rolls over and I get back out, then I'm done till February. Right. So, the first part is really critically important. And so is the second part, but then you add in the third part and it gets tough.
We're playing chess, not checkers.
Yeah.
Right?
Yeah.
This isn't, you have to think at least 2 or 3 kind of moves ahead, at least 2, the one you're going to do and the next one. You have to. If you're not thinking about what your next position is after you take a position, you're winging it, and that's not a full plan, right? That's a partial plan. Yeah. And I think your plan's based on hope if you're doing that. And so hopefully you guys are taken away from this. And we, if you watch our show all the time, you might get tired of hearing us say this.
Yeah.
But we always have to assume that, there's new people watching and they might not go back 5 episodes and hear us talk about this stuff. But it really is the fundamental key to our methodology, right? Is being in the market when the trend is up and being out of the market when the trend is down. Any given fund. And when I say market, I just mean anything, right? If the F fund is going up, that's not really, it's the bond market, but it's bonds, right? Regardless, we got 5 options. And sometimes we might spread them apart a little bit because 2 might be going up as they are right now, right? Sure. The IDF. Anyway, the point is, be in when the trend is up, be out when the trend is down, understanding that you only have 2 moves a month.
Yep.
But you have to finish that sentence, right? And so when people hear us say, "Oh, be in when the trend is up," well, the trend's up, buddy. Why aren't you in?
Right.
I got 2 moves a month,
right?
And I got to use them strategically, and so it's the long game,
right? And so when we say trend, 2 days doesn't make a trend.
Doesn't make a trend. Yeah.
We can't. 2 days can make. 2 days can be a giant trend if you're looking intraday. If you're looking at a 5-minute chart, you could have been in and out 6 times in 2 days.
If you're in your brokerage account or something where you can do that, have at it. Have at it. Yeah. But that's not the game we're playing.
Right.
It's not the game we're playing.
All right. So a quick look at the TSP fund charts like we do every week. C Fund did we had talked about put in a buy trigger on a weekly basis last week. The problem is that we just barely, if at all, ticked above 50 on the RSI. And we were bumping up against the downtrend line and the 200-week moving average line, which is not on this chart. But technically, we got a buy trigger because we were above that 20-week moving average line, and we were just barely at or barely above 50 at the end of last week. Not strong enough for me, anyway, given the resistance at the 200-day moving average and the downtrend line. So we didn't reallocate to the C fund, and now as of the close on Thursday, we are back below that 20-week moving average line, and we're back below 50. So until we can break through up there, ideally back above that December high, the C fund is just not the place to be. From an odds perspective, I mean, if you believe it's going to go higher, if you say but we got a head and shoulders pattern, and if you want to say this is the neckline, and as soon as we break it, we're going to go higher. Yeah, there's a lot of ways you can look at this chart, but right now it's in kind of no man's land. If we get above the December high, odds are we move higher. If we get below the December low, odds are we at least test 3,500, which was the October low, and more likely than not, we keep on going. So you're kind of in no man's land right now. S Fund, kind of similar, right? Last week we got above that 20-week moving average line, but RSI barely, if at all, at 50. And then this week we're back right to that 20-week line, and RSI is rolled over, still right about 50. So you're in no man's land. Until, and now we're bumping up against a pretty significant resistance level right here at 1,700-ish, right? We hit that line going back to the end of October, 1, 2, 3, 4, 5, 6, 7 times. So this is actually a bullish triangle. If you drew a line across here at about 1700 and went this way, we could come down, come back up, and then break through. So this is actually a bullish triangle, but it's coming off of a big bearish move to the downside. So how it ordinarily resolves is in the direction of the prior trend, which is down. So you have the prior trend down, you have the triangle, and you have another equal length down, is academically how it would work. So S fund is not your friend right now. I fund is a completely different animal, right? You got the downtrend line. We broke through it. We broke through the 20-week moving average line. RSI got above 50 back here and has stayed above it consistently as prices moving higher. I mean, the I fund is in a much, much better place than the C or the S fund. F fund, not as strong as the I fund, but certainly a lot stronger looking than the C or the S fund. We had a breakout above that 20-week moving average line, little tick above 50, came back down below it, right? Got below that line for 1 week, and then the last 3 weeks. So basically, I would call this, a little bit of a failed support, but close enough. We did have 1 week's close below that line, but then it picked right back up, and now we have a higher high. So F fund is looking much stronger than either the C or the S funds. All right. That is all I got.
Questions?
Yeah.
If you have questions, as always, you can put them in the comment section wherever you find the video.
Yep. And if you're a subscriber to the site, the point is for subscribers to the site, you have to make a decision on a day. You have to go through the 3 steps of the decision process, and you have to make a decision on a day to reallocate. So we talk about weekly charts here on the show, and it gives you guys a really good idea, at least how we think the trend of the market is going.
Yeah, big picture.
Big picture. When you actually come down to making a decision what day you're going to make a reallocation, there's obviously more involved in it to for the third part particularly, how many moves do we have remaining in the month, the percentage allocations into each fund, how confident are we? Right now we're 50.
And what we might do next.
Right,
and
yeah.
What plan B might be.
Right. So
we don't get into all of that here on the show.
Right.
But in the weekly newsletter, so yeah, if you're a subscriber, I think you have to watch both, right?
Yep.
I think you need to watch this because we educate a lot more on this.
Yep.
And the newsletter that comes out on Sunday night, that you go and read, and he's also got a video walkthrough, that really digs into what happened last week, what should we be looking for this week, what, allocation possibilities are we looking at, way more deep analysis. So if you haven't never seen, and if you're not a subscriber, you want to see what that looks like, you can go to our website, and I think you have to go back a month, right? So the current month is always just subscribers. Yep. You go back behind that, back farther
4
than
weeks.
that,
Yep.
then you can see previous newsletters, right? That are dated, but you can see how deep we go into this. So take a look at it.
Yep.
All right. If you have any questions and there's no comment section, wherever you find something, you can always shoot us an email at support@growmytsp.com. Customer service gurus will be happy to pass it on if they need to. Hope you guys have a great week. I hope, hopefully your months aren't flying by as fast as ours. All right. Take it easy.
Out of here.
Be safe.